Welcome to our latest finance event at the UTS Business School on today's beautiful sunny Friday. My name is Gerhard Hambusch, and on behalf of the UTS Finance Department, I'd like to provide a warm welcome to all guests, presenters, and industry guests. Today we have 3 UTS Finance researchers presenting some of their latest fresh finance research. We picked topics relating to sustainability, addressing climate change, and exposure of wrongdoing in capital markets to showcase some of the core values and strategic goals of the UTS Business School. We are excited to have won Dr. Alan Rai, who is a UTS Honorary Adjunct Professor. Alan, may I please ask you to share with the audience what you do in your professional life and why you are interested in finance research to help us out today?
Thanks, Gerhard. Hi, everyone. Very happy to be with you today. So I work at a management consultancy called Baringa Partners. It's a consultancy that specializes in energy and financial services. It's a 950 staff organization with predominantly operations in the UK. And we have an Australian office in Sydney, which has about 25 people now. And I work in the energy space. So I lead our investment advisory arm, which advises investors in the power sector, what to invest in and what are the risks. And so my interest in finance is very much from that applied angle of taking the concepts and the theories and the ideas that we learn about in project finance, corporate finance, and applying it to the electricity sector. And so I'm very happy to be here today to, provide some of that industry experience and, provide an industry perspective to the great research that is done out of the business school.
Fantastic, Alan. Thank you so much for joining us. And we're jumping right in. We start with Dr. Christina Nikitopoulos. I'm inviting her to share her screen now, who will present wind generation and the dynamics of electricity prices in Australia.
My talk today, it's about the Australian National Electricity Market, known as NEM, which is one of the longest interconnected power systems in the world. And it includes 5 regional markets, including Queensland, New South Wales, Victoria, South Australia, and Tasmania. The market supplies about 200 terawatts hour of electricity, has a generation capacity of more than 55,000 megawatts per year, and supplies approximately 10 million customers. The NEM is currently undergoing major transformation in terms of its generation mixes. It has been a dramatic increase in variable renewable energy generation, such as wind and solar, at a rate which is 10 times higher than the global average. This is driven by government policy incentives, such as the Renewable Energy Target Scheme, as well as the declining cost of VRE due to technological innovation. The figure here compares the VRE penetrations in several countries and Australian states, which essentially refers to the VRE generation scaled by consumption. As we can see, South Australia has more than 125% VRE penetration, which is the highest in the NEM and second in the world, following Denmark. So these are certainly great news in terms of the national efforts in reducing greenhouse gas emissions in the electricity sector. Yet this surge has contributed to an increase of blackouts, increased incidents of negative prices across all states in the NEM, most of them caused by wind or solar generation, and a fall in the revenues earned by coal-fired plants, forcing them to shut down prematurely. So the NEM is currently facing major challenges in terms of the variability of electricity prices and the system security and reliability. So all of these raise the important question of what is the historical relationship between wind generation and electricity price dynamics, and what are the future implications. So what we found is that increased wind generation is associated with a decrease in electricity prices for all states. So we confirm what is called the merit order effect for wind generation. After accounting for the electricity consumption, then we find that the price reductions are more pronounced in states that they have low wind penetration, such as New South Wales and Victoria. Of course, there are other contributing factors, such as consumption, gas prices, and hydro generation, which are all positively impact electricity prices, with interconnectors having a substantial impact as well, mostly for net importing regions and interconnectors that have larger thermal capacity. The more interesting thing here is about the volatility. So wind generation, we found that tends to increase price volatility, with the effect stronger in states with higher generation levels, such as South Australia. Further, consumption, gas prices, and hydro, they all positively related with price volatility, and interconnectors, again, play a dominant role, with Victoria inducing the stronger net volatility spillover in the NEM. The interconnector flows from Victoria to New South Wales and South Australia increase the price volatility, most likely due to the withdrawal of the Hazelwood coal-fired plants in Victoria, and of course the high wind output that happens in South Australia. So to wrap up, what our study shows that yes, wind generation has been successful in decreasing electricity prices in the NEM, but has increased their price volatility. And this echoes the challenge faced by NEM, where with the increase of wind generation, it becomes more difficult to equilibrate demand and supply in the network. This underscores the importance of increasing investment in fast start, firm and flexible, as well as interconnector capacity to be able to smooth out this price volatility. Although currently storage capacity is limited in the NEM, future developments and proposed storage projects are expected, which will contribute in improving the system's reliability and, of course, shaping the future of Australia's energy markets. Thank you.
Lovely. Thank you, Christina. And I'm inviting Alan to provide some comments.
Thanks, Gerhard. So I've just put together a slide to summarize some of the questions and that triggered in my mind when I read the paper. I should say, for full disclosure, that I'm actually one of the co-authors.
Thanks.
So I will try to be as constructive and unbiased in my criticism as I can be. So firstly, I found the paper a really good read. Goes without saying, almost goes without saying. And with lots of practical significance. Firstly, as Christina mentioned, there's a lot of emphasis being placed on renewable energy schemes in Australia and indeed globally. In Australia, of course, we have a federal scheme called the Large Scale Renewable Energy Target, which goes to 2030. But the big driver over the past 12 to 18 months has been at the state level, a state government level, where each state across Australia now has some form or another of a emissions reduction target for the year 2050. It varies depending on the state. For example, Victoria has a net zero by 2050 target, which has been legislated. New South Wales has announced that target, but there's no legislation. And similarly, in other states, there's varying degrees of commitment behind that announcement. So it's clearly a very topical area. And given those state-based ambitions and targets, it's entirely expected that variable renewable energy, or VRE, penetration or uptake is set to increase, in fact, in some states by a factor of 4 or 5. The question that comes from that, and this is a very much an applied question, which is the second point here, is about who bears what I call the variable volume risk. The challenge with wind and solar, with both, as Christina mentioned, is that they're variable, which in and of itself isn't an issue per se. It's when you couple the variability with the fact that the output tends to be at times of low demand. If we had variable volume risk, but that variable volume was manifesting itself at peak demand times, then it'd be less of an issue because the energy would be needed at that time. And of course, in other commodity markets, typically inventory would absorb that. You know, if you produce more at the wrong time, you would just store it as inventory. But in electricity, the cost of storages remains very high, very expensive, especially for storage beyond 3 or 4 hours in duration. And so that's the challenge. When you have costly storage and costly inventory, if you add generation to the mix that's not well correlated with demand, you then have a balancing problem. And this problem is likely to increase given that quadrupling in VRE penetration that I mentioned. And historically, other generators have borne that variable volume risk. It's been essentially passed to other generators, primarily incumbent coal generators. So that's a question about who should bear that risk going forward. Should it continue to be other generators, somebody else, or should it be passed back to the individual wind farm or individual solar farm themselves? The third thing that struck me was that there's more of a practical side to this, which is very much embedded within the finance industry. The previous things I mentioned were more on the policy side, and that is around sort of how to take Christina's results and apply from a pricing, a financial instrument perspective. We have option contracts in the NEM. They tend to have standardized strike prices and the like, but they're very much like a call option. And they have implied volatilities to them. Obviously, we need to determine what the right volatility pricing model should be, and it's typically not Black-Scholes because the underlying price distribution is definitely not log normal. But there are certainly off-the-shelf pricing models that are designed to price electricity options, and so there's an implied volatility that goes with those. And the question then is, can you use Christina's EGARCH model to better predict, or is it better correlated with implied volatility than other volatility measures such as realized or historical volatility? So that was one thing that has struck me throughout the work, has been that option pricing angle. And then finally, the design of electricity derivatives, especially power purchase agreements, which touches on the second dot point there about who should bear the risk. And this is in relation to really negative prices. Now, negative prices might seem like a very odd thing. In most commodities, we don't see prices going below zero. In fact, in pretty much every good and service, with the exception of, I suppose, oil in recent times, where we've seen the price there go negative. But in electricity, it happens pretty much on a daily basis. We don't see it because our retail price is unfortunately not negative, which mine was, but it never is. So we don't see it, but certainly at the wholesale level, we see it. And one of the challenges is that some of the volatility that Christina mentioned can be amplified depending on how you design and structure those electricity derivatives. Essentially, if you make the generators that are selling those derivatives completely insensitive to the spot price, then they generate whenever the resource is available, irrespective of what the spot price is. And that feeds into, there's a policy angle to that. There's also a commercial or a market angle around how you structure those contracts and who should bear the risk. The key point here is that can be a source of amplification of volatility if designed in a way that allocates that risk to somebody else. That was all from me. Thanks. Yeah.
Fantastic, Alan. Thank you. You're a great example of how we are able to reach out to industry or members of the industry and work with them together, not only in research, but in your case also in supervising, for example, research students. So I think this showcases nicely how we have this great, valuable collaboration at work. So thank you very much for that. And we have one question here from the audience. The audience question is, but does electricity price volatility end up in the bills of retail customers?
As the study have shown, we've seen merit order effect with regards to the wind generation. So we have seen that wind generation to decrease prices, which I think this is what comes to the customers. Now, the volatility, it is something that probably will have more impact on probably the contracts that Alan mentioned with regards to the pricing of derivatives around electricity. But Alan, correct me on this if I'm wrong. So I'm not very sure about how the volatility actually impacts the customers.
Yeah, you're right, Christina. It impacts the customers is the first point, and secondly, the channel through which it does is by increasing the price of these contracts, these volatility-sensitive contracts. So customers end up paying for it not through observed volatility in their retail bill, but through an increase in the general price, in the general retail price, to reflect that higher volatility premium.
So first of all, thank you, Christina, and thank you, Alan, for this first part. And Kenny, if you're ready, please share your screen.
Thanks, Gerhard. Good day, everyone. Well, before I talk about my research, let me just introduce you to this wonderful crypto investment opportunity, right? So, this investment here is called Howie Coins. It's basically some kind of token that links you to a blockchain travel network. They have a fancy white paper. And if you get in really early, you get lots of discount on your investments. There are various tiers, and hey, you even got a very legit looking team over here. And this coin even comes with endorsements from some celebrities, so which is really fantastic. And if you're sold, you may just click on this link here to buy, and bam, you're actually linked to this US SEC website, telling you that if you have responded to this offer like this, you could have been scammed, right? So this is basically like an educational tool pushed out by the US SEC to try to educate investors about the dangers of investing in this crypto assets, right? So the point I was making is basically summed up by this quote. We embrace new technologies, but we also want investors to see what fraud looks like. So that was the whole idea about the Howie coin. I encourage investors to do their diligence and ask questions, right? So this quote is from the former SEC chairman, Jay Clayton. So I understand that not everyone here will be familiar with ICOs. Basically, you can think of ICOs as like the IPOs, of the more traditional kind of stock market, right? It is where entrepreneurs, they try to raise money by selling tokens instead of selling stock, right? They would be selling tokens to fund their blockchain kind of projects. Now, this is by no means a small market. $69 billion have been raised to date and continues to ramp up through this pandemic. Now, what is kind of different from traditional markets is that a lot of this information is self-reported by the entrepreneurs themselves. There is very minimal auditing being done on this information. So in some sense, the ecosystem that we are familiar with in traditional markets, we kind of take that for granted, right? We trust that when we click on the ASIC website to download financial filings, we trust that those financial filings are true. But that is not quite the case for this part of the crypto market. Now, regulation on cryptocurrencies differs across countries. In some countries, it's like an outright ban, for example, in China, but whereas in Australia, it's more lax. Regulators here generally allows possession and trading of cryptocurrencies as long as you make the appropriate tax filings. Now, in the US context, so just a funny thing about the Howie coin. So the Howie coin is actually named after the Howie test, which is a test to see whether a particular product will qualify as a security. If something qualifies as a security, the US SEC actually would require you to register it. But very few ICOs in our sample have actually filed with the SEC, right? So essentially the Wild West of ICOs. Now, what we are doing here is pretty simple. We are trying to predict fraud in these ICOs. There are many methods to kind of predict fraud. What we are proposing here is something that everyone can do, right? So just imagine that you're going to buy a car. And typically you would not, walk into the first showroom and buy the car outright. What you would do is you shop around, right? In various showrooms, try to compare prices, so on and so forth. So now a lot of these ICOs, their information is being hosted on this ICO listing websites. So you can go onto these websites and try to learn about ICOs before you make your investments, right? Something like buying a car and visiting the multiple showrooms. So we are going to be looking at this particular ICO here called AdHive. And on this particular website, it's called ICO Bench. We would download all the attributes of this ICO. We go to another website, ICO Drops, and we download the same information. We go to ICO rating and we download the information for this same ICO. And here's the summary. And as you can see there, highlighted in yellow are the discrepancies or the inconsistencies in this information here. Next, we test whether this number of inconsistencies or misrepresentations can predict fraud. So we take all the ICOs, about 6,000 of them, and we sort them by the number of inconsistencies across all websites. So the line in black are the ICOs with the lowest number of inconsistencies, followed by blue, green, and the red one is the one highest. So the takeaway from this chart right here is that the ICOs with the most number of inconsistencies tend to be has a higher probability of being fraudulent. Right. So the key takeaway ultimately for everyone here is that there is widespread inconsistencies of ICO attributes, and these inconsistencies are a powerful predictor of ICO fraud. And what you can do to protect yourself is just to do some simple cross-site verification. And with that, thanks.
Thank you very much, Kenny. I'm reaching out to Alan Rai to see if he has seen any of those and what Kenny's Swiss pocket knife to fight fraud here can probably do for us.
I don't think I'll struggle to be brief, Gerhard, because this is well and truly out of my wheelhouse. So yeah, very interesting paper, definitely an eye-opener for me. I'm not exactly the most technology savvy in general, and certainly when it comes to Bitcoins and e-currencies, it's I have to ask my son about that, who's 9. He probably knows more about it than I do. So some of the questions I guess have popped up, and I should say that some of these questions may have already been covered off or addressed. So apologies, Kenny, if this is redundant, given the document or the full paper that you're working on. But some of the questions I had was really around, of course, the focus of the study is around what's happening at the ICO time, at that specific time point. But typically we might expect, as that essentially that asymmetric information is revealed, that it means a reduction in the price of that asset. So a question here was around, do we see post-ICO returns of a negative sign and or unusual trading of those ICOs of those coins post-ICO? In other words, is the fraud ultimately revealed through the market learning about it, either through lower prices or through some sort of unusual potentially insider trading? I also, in addition to my technology non-savviness, also had forgotten a lot of the network theory and network models that were behind the work that you have done here, Kenny. So I certainly would have benefited from a better understanding of what the network models are and what they are used for and what are their strengths and weaknesses. And yeah, so that was just one thing I'm sure you're already onto it. I guess the third one was around more of an identification question about how we assess materiality in securities fraud. And that's a broader issue. It's not just related to ICOs, it's related to securities more generally. But that was a question I think I sort of came back to, is how is materiality assessed? And then finally, I guess it would be good to draw out some of the policy or real world implications of the findings. So what's the call to action here, and on which stakeholders should that call to action be placed? So for example, is it around reducing asymmetric information? Is it about more information at the time of the ICO? Is it about sort of levying harsher penalties? When I think about some of the mechanisms that we use to reduce asymmetric information and reduce the risk of the market for lemons, it's around, sort of co-investment, skin in the game, harsher penalties, an enforcement regime, etc. So some of those things would have been good to see in the paper.
Thank you very much, Alan. I throw it over to you, Kenny. Also, maybe I attach a question from the audience to it. Is there a predictive element to this fraud detection? That is, can you look at the aftermarket and see bad long-term performance?
Related to the first question raised by Alan. So I didn't manage to cover this in the very short presentation, but we basically crowdsourced fraud identification from this website called datecoins.com. So datecoins is was a very popular project where people can kind of can list like, oh, coins that are fraudulent and or dead, or basically the issuer ran away with the money. So what we have done is we collected all those coins and then we manually checked to see whether each case is legit or not. So we do not actually use returns or trading activity as an indicator of fraud, because many of these ICOs, they do not even make it to the market. So they do not even get listed. So what typically happens is that they will take your money and then they'll say, oh no, we're going to do this, we have a plan, blah, blah, blah. And then basically they just go dark. Nothing, right? They stop writing code, nothing. So they basically just run away with your money. So on the second question about the network model, so one interesting aspect of the project, which I didn't manage to kind of go deeply into, is really the role of the ICO advisors. So the ICO issuers often hire advisors to help them with technical aspects or the marketing aspects of this ICO. So we find evidence that ICO advisors potentially play a role in this propagation of fraud, right? So the framework is a bit involved, but that's kind of the gist of it. Now on materiality and securities fraud, well, that is a very difficult legal problem, I believe, even today among the legal scholars. But basically, for a piece of information to be material, at least in the eyes of the US courts, it does not have to affect everyone. But at the same time, it cannot affect no one, right? So it does not need to affect everyone, but it must affect someone, right? So, it's pretty vague over there. Now, if we look at the variables used on the ICO websites, we have things like pricing variables, right? What's the hard cap? What's the soft cap? I would argue that these variables are really important in an investor's decision to buy that particular token. So I would think that in many of these cases, that will be material.
Thanks to Alan, first of all, and thanks to Kenny for presenting this research. Kenny, my hope is that your research makes this world a better place. And so UTS is here to help. And everybody's encouraged to look our researchers up. They're all on LinkedIn. Feel free to reach out to them and engage in a further discussion. The third research piece will be presented by Dr. Kylie-Anne Richards, and the topic is climate change transition risk on sovereign bond markets.
Thanks very much, Gerhard. So this work is in collaboration with my colleagues at UTS and also Dr. Laura Ryan from Ardea. The work is funded by Ardea Investment Management, and we've also received lots of helpful input from both the teams at Ardea and Fort Lake Asset Management. So we've been quite fortunate in that respect. Now, jumping right in, so climate change transition risks, so they arise from the process of adapting economies towards a less polluting and greener economies. So the risks present via policy change, reputational impacts, and shifts in market preferences and technologies. So you might ask why climate change transition risk matters. So if we're to assess a company's ability and readiness to transition to a low carbon economy, that is the key part. So, for example, economies with large oil and gas sectors are more exposed to large shifts in asset values due to the global efforts to combat climate change. Also, transition risks materialise faster. So you'll hear lots of conversation around what's called physical risks, and they arise from things like extreme weather-related events. Whereas the transition risks, so they require we're talking about requiring swift and global coordinated response to the climate change policies. And so I have here how we define the transition risks. So it's via carbon dioxide emissions, natural resource rents, and renewable energy consumption. So what is the role of sovereign bonds in transition? So I'll just go back a step and talk about what sovereign bonds are, and then we'll step into why this is quite important for this discussion. So sovereign bonds are debt securities. They're issued by governments to raise capital to finance infrastructure, social programs, pay old debt, and so on. Now, this chart here shows the cumulative global bond issuance from 2010 to 2020. And it's also worth noting that, those who are familiar with the bond markets will already know this, but they're significantly larger than the equity markets. Now, one of the key methods of financing climate change mitigation is via the sovereign bond markets. So understanding and pricing in climate change risks associated with sovereign bonds is core to the reliable functioning of these bond markets, particularly given this critical role that they'll play in supporting fast transitioning to a low carbon economy. Now, many governments, unfortunately including Australia, are pushing back suggestions to include climate change risk when they sell bonds to investors. So it's believed that the likes of green and social bonds would be a solution, while the inclusion of climate change risk is not required in the federal government's debt pricing. So we challenge this by demonstrating that climate change risk has been globally priced into sovereign bonds with a particular focus on transition risk. Now, this is a busy slide, and unfortunately I won't have the time to talk to all of it, but in this study, so we're assessing the significance of carbon dioxide emissions, natural resource rents and renewable energy. So there are our measures of climate change transition risk, and this is in determining sovereign bond yield spreads. Now, what we find is that carbon dioxide emissions increase a country's cost of borrowing in debt markets. Natural resource rents and renewable energy consumption matter to the advanced market yields. And sovereign bond markets, especially in advanced countries, price the climate change transition risk. So in terms of what countries are more exposed to transition risk, so we see that advanced countries have the political and financial resources to respond to climate change transition risk. So it's expected that the transition risk could be priced more effectively in these advanced countries. Now, the response of the developing countries is slower, yet they would suffer, I guess, a higher opportunity cost of the transition risk. For example, they will not be able to exploit their natural resources due to the climate change policies that would lead to lower demand. Now, what this means for policymakers and, I guess, bond market investors, so prioritising renewable energy supply and consumption and also foregoing the short-term opportunity cost of reduced revenues from natural resources would potentially lower the cost of borrowing in sovereign bond markets. So this means that cheaper financing would counteract potential short-term losses arising from asset re-evaluation, while the savings made from the financing could be invested in renewable energy technologies and smoother transition away from the fossil fuel industry. Further to this, a country's reputation on managing climate change risk may affect the credibility and liquidity of its debt. Then there's the timely implementation of climate change policies, which are critical in achieving the climate targets. So governments should start by being more transparent with how this risk is measured and factored into policies and strategies. So this work that I'm presenting very briefly today provides evidence of a clear connection between climate change and the sovereign bond risk. And also the renewable energy is an economically and statistically significant mitigation strategy. I think I am running out of time, and I did promise Gerhard I wouldn't go over. So I'll finish up with saying, so the findings of this paper, so they give sovereign bond market participants a clear case to request greater government transparency on specific climate risk strategy and policy that is inherently linked in the bonds they issue. Thanks very much.
Thanks very much, Kylie, and I'm handing it straight over to Alan Rai.
Thanks, Gerhard. I'll try and provide hopefully a useful, but nevertheless a whistle-stop tour through the paper as I read it. So I think it's a fantastic piece of work. I congratulate the authors on venturing into the space. It's certainly a key area to think about. And when I first read the paper, the first thing I thought of was the Saudi Aramco IPO, which happened last year, and it was a record amount of money that IPO raised. And straight away I thought, well, the cynical view on this is that the markets aren't pricing either physical or transition risk, given it's an IPO of an oil company. But I think it's nevertheless the more informed view is to actually look at what the data is saying. So most of my questions or comments here around the data and the econometrics of the analysis. But take each of these in turn. The first question I had was around the transition risk measure. Emissions can be certainly considered a transition risk measure. They could also be considered a physical risk measure, because the higher your emissions, potentially the higher the physical risk exposed to you. It's not entirely physical risk, because of course you can have countries in different parts of the world that are more exposed to physical risk than others. Equatorial countries that don't emit very much can have a lot of physical risk exposure whilst not having much of a transition risk exposure. So it certainly isn't perfectly correlated, but there was a question there I had about whether some of the coefficient estimates that you were getting on the emission side might reflect both physical and transition risk compensation. And then the second question was around, well, are there potentially other transition risk measures? The ones I've seen, which admittedly are an industry, are things like, measures of fossil fuel penetration or reliance on fossil fuels. So not necessarily resource rents, which I guess are the quantification or the monetization of that. It's more about the sort of reliance measures directly. The third one was around sort of some of the transformations that the paper did, like, taking the square root. That wasn't sort of clear to me why that was done. Potentially another way to do it could be through a sort of per capita based emissions metric that might scale for the size of the population and give you a better sense of essentially emissions intensity of the country. And then a couple of others, I'll just run through these and then we can have a chat. The control variables, there was I think one of the key questions was, why does developing nations coefficients kind of go the other way, where they actually have, something like lower spreads associated with higher emissions or something, but it was basically the opposite of developed nations. And so my question was, can some of those conjectures be tested via extra control variables rather than just, sort of verbal conjecture? And then finally, probably the most smallest point of them all is, sort of when you compare spreads in different currencies, it's sometimes hard to do that because of the differences in currencies. And typically, and this is based on my previous experience in industry, that you would use a cross-currency basis swap to put all the bond spreads into a common currency, which has the effect of taking off a few basis points on some of the currencies most at risk of devaluation. And that probably won't really drive your results too much, because you're seeing hundreds of basis points differences, not tens. But that's just something that a pedantic referee might pick up. Thanks.
Thank you very much, Alan. And Kylie, I give it back to you with a question from the audience. How do you control for differences in inflationary expectations among your sample nations? And a second question, maybe, what you foreshadow as impact of this work?
Okay, thanks. Well, firstly, thanks, Alan, for your feedback. And I will make some comments on that first, if that's okay. So in terms of the physical risk compensation, I agree with your comments around that. I think what's been used in other literature is this ND Gain Vulnerability Index, which we did look at in terms of physical climate risk. And there's quite a significant lack of variability in that index. So I think that, that was a factor that was difficult to separate. It's factors that are difficult to separate out from transition risk, but that also wasn't an appropriate index to use. My first comment to your suggestion around other transition risk measures were in terms of reliance on fossil fuel use. My first thought was thinking, well, natural resource rents are doing that, but I do take your point about your other suggestions around that. So I think that there are other areas or other, factors that could be considered above and beyond how transition risk has historically been defined. Jumping to, say, control variables, that's an extension to what we're looking at. So things like time series of ratings, governance, quality measures. There is still some work I think that we can do very much to enhance the research on that. Now, your final point on this cross-currency basis swap spreads, I thought that was a really great question, actually. So just to give some context around that, what it means for those who may not be as familiar, and hopefully I'll get this right. So we're talking about converting spreads back to a common constant currency and what the actual yield is looking at what the actual yield is in terms of constant currency basis. So if we consider the countries in silo, then I think the country spreads are appropriate. However, I think your suggestion is actually another way that we could augment the analysis. The only thing that I was thinking of there, and maybe that comes back to some of the, there wasn't a question on inflation in the chat, is that we would need to consider things like inflation rate in this setting. So be looking at real yield swap back rather than a nominal yield swap back. For the question in the chat, I'm not sure if I've got this right, but I did have some commentary on the developed versus advanced economies and the differences, but I'm probably going to go over time if I continue on down that path. So we do have inflation as one of the control variables. in the model, but I'm not sure if that's exactly answering this question around inflation expectations. So I'll probably need to have a little think about that and come back. Sorry, now have I missed another question? I think there was a question by Laura about investor implications as well, or was there something else, Gerhard, that you wanted me to?
I think there was a question about the suggested impact of this work, and if you can, or your foresight of potential impact of this work.
Yeah, so I think the investor implications are a big one, which we haven't really covered in the last slide so much. So liquidity is a key factor here. So this will have significant impact on liquidity, which will drive up the cost of debt. So you'd expect a liquidity premium, and in turn, this worsens fiscal situations. And if we assume carbon's priced efficiently, and we consider areas of like carbon intensity, and I guess what we'd expect a carbon price to be included, then this could drive up costs of businesses, less efficiency, lower productivity. So there's a flow on to the corporate debt yields, which I think is something that not too many people may have considered. And there's other aspects. So you lead to a higher cost nation, higher inflation, higher cost of capital, higher nominal yields, creditworthiness, and so on. So there's very much a circular paradigm that's at play with what we're seeing in terms of the impacts of these transition risks on the sovereign bond yields. And I guess you can see this in the coal industry in Australia, which has become really high cost, extremely expensive. The cost of capital is very high. So I think that's one that's playing out.
Fantastic. Thank you, Kylie. And research is fun, but we never have enough time to really further discuss. We would like to thank you, the audience, and all presenters, and Dr. Alan Rai for a very interesting research lunch hour, as I find. We invite the audience to follow us on LinkedIn and also visit our YouTube channel to find our past events on demand. For example, last week's interesting discussion on cryptocurrencies and decentralized finance. We will be back on 16 September with a lunch discussion on ESG, the environmental, social justice and governance components and risk factors in investments. Thanks once again on behalf of the UTS Finance Department.